Welcome to Beacon of Books, where we turn the world's best books once into concise and powerful insights you can learn in just minutes.
At a quiet moment in life, when a person pauses to reflect on their financial future, a young man sat alone, scrolling through economic news. His eyes moved quickly between stories of sudden wealth and unexpected financial collapse. He felt confused. Why do some people build steady, lasting wealth, while others lose everything, even when they seem smarter or more daring? Amid this noise, he came across a book titled The Little Book of Common Sense Investing. The title was not flashy. It didn't promise quick riches or secret shortcuts. Instead, it offered something surprisingly simple: common sense. He began to read, not knowing that these pages would completely transform the way he viewed money and investing. From the very beginning, he encountered a powerful idea. In its simplicity, successful investing does not depend on extraordinary intelligence or the ability to predict the future. It depends on following a simple, logical strategy over the long term. The young man had always heard advice like, "Buy now, sell tomorrow, this opportunity won't come again. The market is about to explode." But the book told him something entirely different. Stop trying to beat the market and start investing in it. That was the turning point. The first lesson he learned was this: over the long run, the market grows. It may rise and fall. It may go through crises and uncertainty. But in the end, it reflects the growth of the economy and human productivity. This means the best way to benefit from that growth is not by timing the market, but by staying invested in it. But how? The answer was surprisingly simple: invest in index funds. Index funds are investment tools that do not try to pick the best stocks. Instead, they invest in the entire market, such as the S&P 500. In other words, you are not betting on one company, but on the overall economy. At first, this seemed boring to the young man. Where is the excitement, the challenge, the quick profit? But as he continued reading, he realized that this boring approach was actually the secret. The book explains that most investors, even professionals, fail to outperform the market over the long term. Not because they lack intelligence, but because costs and emotional decisions eat away at their returns. This led to the second lesson: small costs make a big difference. Management fees, commissions, trading costs, they all seem small at first, but over time they accumulate and significantly reduce your returns. The young man began to understand that successful investing is not only about choosing what makes you money, but also about avoiding what silently takes it away. Then came another critical lesson: emotion is the investor's greatest enemy. When the market rises, people feel excited and invest too late. When it falls, they panic and sell at a loss. As a result, they buy high and sell low, the exact opposite of what they should do. A wise investor, however, sticks to a plan, regardless of market noise. The young man remembered how many times he had made impulsive decisions driven by fear or greed, and how much those decisions had cost him. He realized that investing is not a battle against the market, it is a battle against oneself. As his journey continued, he discovered another powerful truth: time is the investor's greatest ally. It is not important to start with a large amount of money. What matters is starting early and staying consistent. Compound returns work like magic. Slow at first, but increasingly powerful over time. Each additional year in the market is not just time, it is an opportunity for growth. Then he encountered another idea that changed everything. Do not try to be too clever. Many people believe that complexity leads to better results, and that sophisticated strategies outperform simple ones. But the truth presented in the book is quite the opposite. Simplicity, when followed with discipline, often outperforms complexity. A low-cost index fund, regular investing, and long-term patience, that is the formula. It is so simple that many people overlook it, yet its power lies not in complexity, but in consistency. Over time, the young man began to change his behavior. He stopped chasing daily news and market predictions. Instead, he created a clear plan: invest regularly in index funds without trying to time the market. At first, he felt uncertain. Was he missing better opportunities? Could he earn more by being more active? But as time passed, he began to see results. His investments were growing, slowly but steadily. Market fluctuations no longer frightened him. They became just temporary moments in a much longer journey. Then he realized a truth that reshaped his entire perspective. Wealth is not built through big leaps, but through small, consistent steps. At the end of his journey, the young man sat once again, but this time he was no longer confused. He was calm, confident, aware that the path to success is not about chasing the big win, but about committing to what is logical, simple, and proven over time. He closed the book, but not the idea. He understood that success in investing does not require genius, but discipline. Not speed, but patience. Not risk-taking for excitement, but consistency for results. And most importantly, to trust that the simple path, even if it seems ordinary, is the one that few people follow. And that is why it leads to extraordinary outcomes. Now, the question remains, will you follow the noise of the market, or will you choose the path of common sense that quietly builds real wealth over time?
This was a summary of today's book from the Beacon of Books channel. If you liked the video, don't forget to like the video and subscribe to the channel to receive all the new content.